interest rate announcement. Le gouverneur Macron va prononcer sa déclaration préliminaire. Ensuite, on va tourner aux questions des journalistes. After Governor Macron's opening remarks, he and Senior Deputy Governor Carolyn Rogers will be pleased to take questions until about 11:15. Over to you, Governor.
Thank you, Rebecca, and good morning. I'm very pleased to be here with the Senior Deputy Governor to discuss our monetary policy decision. Today, the Governing Council maintained the policy rate at 2.25%. We have three main messages. First, steep U.S. tariffs on steel, aluminum, automobiles, and lumber have hit those sectors hard. And uncertainty about U.S. trade policy is weighing on business investment more broadly. But so far, the economy is proving resilient overall. Second, inflationary pressures continue to be contained despite added costs related to the reconfiguration of trade. Total CPI inflation has been close to the 2% target for more than a year now, and we expect it to remain near the target. And third, in the current situation, Governing Council sees the policy rate at about the right level to keep inflation close to the 2% target while helping the economy through this period of structural adjustment. Nevertheless, uncertainty remains high, and the range of possible outcomes is wider than usual. If the outlook changes, we are prepared to respond. Aujourd'hui, le Conseil de direction a maintenu le taux directeur à 2,25%. Nous avons trois messages clés. Premièrement, les droits de douane américaines élevés sur l'acier et l'aluminium, les automobiles et le bois d'œuvre ont porté un coup dur à ces secteurs. De façon plus générale, l'incertitude entourant la politique commerciale des États-Unis pèse sur les investissements des entreprises. Mais jusqu'à présent, l'économie se montre résiliente dans l'ensemble. Deuxièmement, les pressions inflationnistes sont encore contenues malgré les coûts supplémentaires associés à la réorganisation du commerce. L'inflation mesurée par l'IPC global est proche de la cible de 2% depuis plus d'un an, et on s'attend à ce qu'elle y reste. Et troisièmement, le Conseil de direction considère que, dans la situation présente, le taux directeur actuel est essentiellement au niveau approprié pour garder l'inflation près de 2%, tout en aidant l'économie à traverser cette période d'ajustement structurel. Mais l'incertitude demeure élevée et l'éventail des issues possibles est plus large que d'habitude. Si les perspectives changent, nous sommes prêts à réagir. So let me expand on how we're interpreting new information, the new information we received since we published our October Monetary Policy Report. In November, Statistics Canada published broad revisions to Canada's economic growth numbers for 2022, 23, and 24. The revisions suggest the Canadian economy was healthier than we previously thought before we were hit by the U.S. trade conflict. In particular, they suggest both demand and economic capacity were higher coming into this year. This may explain some of the resilience we're seeing in more recent data. After falling 1.8% in the second quarter due to sharply lower exports, Canadian GDP grew 2.6% in the third quarter. This was much stronger than we expected, but largely reflected volatility in trade. Final domestic demand was flat in the quarter. We expect growth in final domestic demand to resume, but with an anticipated decline in net exports, GDP growth is likely to be weak in the fourth quarter before picking up in 2026. The labor market is showing some signs of improvement. After declining through the summer, employment has posted solid gains for the past 3 months, and the unemployment rate has declined to 6.5% in November. Since the start of the year, there have been significant job losses in trade-sensitive sectors, but in recent months, employment in these sectors has been more stable, so gains in other sectors, particularly services, have boosted overall employment. Looking ahead, however, we're seeing muted hiring intentions across the economy. Inflation has evolved largely as expected. CPI inflation was 2.2% in October, and measures of core inflation remain in the range of 2.5% to 3%. In the months ahead, we will see some choppiness in headline inflation, reflecting the temporary GST-HST holiday a year ago. This is likely to push inflation temporarily higher in the near term. Seeing through this choppiness, we expect ongoing economic slack to roughly offset cost pressures associated with the reconfiguration of trade, keeping CPI inflation close to the 2% target. The recent federal budget includes increases in government spending, particularly in defense, and measures. The recent federal budget includes increases in government spending, particularly in defense, and measures to increase public and private sector investment. It will take some time for the impact of these measures to be fully realized, and we expect they will contribute to growth in both demand and supply in the economy. As usual, we will incorporate.
我在前面在调试那个封面图啊，那个封面图，他把上次我直播那个国会的那个辩论的那个被我误弄上去了。大家好啊，欢迎大家来到姜饼哥的频道啊。今天那个还没有开始啊，所以我们现在先预热一下啊，听一下那个 Tiff Macklin 啊，今天早上宣布保持利率不变啊。我先把我的声音关小一点啊，你们听一下他怎么说的啊。
Governing Council therefore decided to hold the policy rate unchanged. We agreed that a policy rate at the lower end of the neutral range was appropriate to provide some support for the economy as it works through the structural transition while keeping inflationary pressures well controlled. Finally, Governing Council acknowledged that uncertainty remains elevated. This includes the unpredictability of U.S. trade policy, and in particular, the upcoming review of the Canada-U.S.-Mexico agreement is creating uncertainty for many businesses. There's also uncertainty about how the Canadian economy will adjust to higher U.S. tariffs. The volatility we're seeing in trade and quarterly GDP make it more difficult to assess the underlying momentum in the economy. Nous allons évaluer les nouvelles données par rapport à nos prévisions. Si un nouveau choc ou une accumulation de données vient changer nos perspectives de façon importante, nous sommes prêts à réagir. Les frictions commerciales accrues avec les États-Unis vont entraîner pour notre économie une perte d'efficience, des coûts plus élevés et des revenus plus bas. C'est plus qu'un ralentissement cyclique, c'est une transition structurelle. La politique monétaire ne peut pas rétablir l'offre perdue, mais elle peut aider l'économie à s'ajuster tant que l'inflation est bien maîtrisée. La priorité de la Banque est de préserver la confiance des Canadiennes et Canadiens dans la stabilité des prix pendant cette période de bouleversements mondiaux. We will be assessing incoming data relative to our outlook. If a new shock or an accumulation of evidence materially change the outlook, we are prepared to respond. Increased trade friction with the United States means our economy works less efficiently with higher costs and less income. This is more than a cyclical downturn. It's a structural transition. Monetary policy cannot restore lost supply, but it can help the economy adjust as long as inflation is well controlled. The Bank of Canada is focused on ensuring Canadians continue to have confidence in price stability through this period of global upheaval. And with that, we'd be very pleased to take your questions.
Thank you, Governor. We'll start with questions here in the room and then go to reporters who are joining us remotely. As usual, please limit yourself to one question so that we can get to every media outlet. Before asking your question, kindly state your name and affiliation. Avant de poser votre question, prière de vous identifier. Libre à vous de poser vos questions dans la langue officielle de votre choix. We'll start with Mark.
Thank you for taking the question, Mark Reynolds with Globe and Mail. Wondering about the labor market. We've had 3 strong reports in a row. You seem to be downplaying that a little bit, talking about weak hiring intentions, trade-sensitive sectors being hit. And so I'm just wondering how we should be thinking about how you're thinking about those 3 strong reports in the state of the labor market right now.
Well, look, first, Mark, I mean, we're pleased to see the improvement in the labor market. As you said, we've had, three reports with important job gains. The unemployment rate has come down to 6.5% in November. It's ticked down through the last 3 months. Pretty big move in November. So look, that is encouraging. And
今天他在开这个会议之前啊，就那个新闻发布会上就说了啊，3点不降息的原因有3点啊，一个是GDP 2.6%啊，这次数据比较好啊，在美国关税打压下啊，加拿大的经济好像他说韧劲啊 ，really 怎么说这个单词啊？怎么说的这个单词？就说它的韧劲是相当足的啊，所以就是保持利率不变。第二个问题就是在那个失业率啊，失业率是现在是降下来了啊，这个大家都知道，现在这个失业率就是它的统计的方式不同啊，还有一个就是很多季节性的原因啊，把那个临时工啊，在10月、11月、9月、10月、11月这段时间应该都是holiday 季节啊，消费季节啊，这个临时工增加了啊，再加上那些好像这个月是因为那个叫什么医疗工作者啊，又加了好多个职位啊health 加了好多职位啊，所以就业数据不错。第3个他说的就是通胀啊，现在虽然是他认为明年通胀还是会控制得好，因为美国的这个关税啊带来的经济不好，所以这个大家都没钱嘛，所以他不用他去加息啊，这是他说的啊，之前他在这个视频里说的，所以就算通胀会上去啊，但是因为可能大家都没钱了吧，所以这个通胀就也不会涨太多啊。我们来看看那个会议开始了吗？找谁看呢？找一个专业点的电视台啊。
When you look at payroll data and weekly claims, it looks a little better than, say, the ADT data. We talk to a lot of companies that we invest in, and we hear the same message back. They're still trying to figure out what the impact of tariffs and AI.
有谁来了？大家可以在评论区打个招呼啊！大家给姜饼哥点点赞。我看他这个还是这个女的啊，上次好像也是这个女的。现在股票好像 S&P 500啊，没什么涨跌啊。国债收益率下来一点啊，0.02，啊，这个不多。我来看看我们来看看 股票最近什么情况啊？Bitcoin 现在是这个 Bitcoin。Bitcoin 稍微跌了一点啊，差不多啊，没什么涨。加拿大股票也没什么涨跌啊 ，S&P 500也是差不多啊。道琼斯涨了0.3%，加元对美元是涨了0.05%啊，也是不多啊。美国应该是会降息啊，就是会不会降50个基点啊？大家都有些人在期待会降50个基点，我们不知道今天会不会有那么高的降息幅度啊？利率决定应该是11点啊，应该是11点啊，还有10分钟啊。他到11点半啊，他会有一个 meeting 啊，就他有一个 conference， 有个会议啊，简报。我们到时候听听他会议后，主要是降这点是大家都知道啊，应该不会有太大的变化啊，降25个基点啊，就是看最后他是怎么说的啊，明年到底是什么情况。Mark Watt 说强烈感觉美国大盘指数要大跌啊。我们来看看啊，好像现在就因为降息，好像没有什么大的声音是吧？这也不知道的，可能他说明年他不干了啊，换了一个人，换一个新的美联储主席啊，这个幅度降息幅度加大了啊，像川普说的啊，降息幅度加大了。好像我看 Meta 跌1.8%啊，好像是跌的最厉害的，就我这里看到的啊，我平时关注的这些股票跌的最厉害的。加拿大的股票还是在涨啊，应该都是符合市场预期吧。我们看看最终是降多少。你们能听得见我讲话吗？听得清楚吗？还是他的声音太响了？电视机的声音太响了。听我讲话能听得清楚吗？啊，在评论区讲一下。杰看到的你在吗？对，利好出尽是利空啊，最主要还是看就是他明年的情况，明年的预测啊，点阵图明年到底是怎么样？之前他说，9月份的时候点阵图是明年预测是会focus 是降2次啊，1次到2次好像，就不会大幅度的降息啊，它没有必要降太低啊。现在你看通胀什么。那个股票什么都涨得不错的啊，没有必要降得太低啊，也要控制住啊，降得太低可能也对经济太火热了啊，以后又要加了。今天好像大家对降息加息的热情不高涨啊，没有9月份那次高涨啊，9月份那次是挺高涨的。 估计一半的股票已经在构筑头部了。大家都在等啊，你们觉得有没有可能降50个基点呢？有人说，我看有些人很激进啊，说这次站出来说鲍威尔不干了啊，说他不干了，降50个基点啊，股票大涨，大家都笑死了啊。还有谁来了？大家可以打打招呼啊，我们先预热一下啊。还有谁来了？我再找一下啊，再找一下，还有其他的频道在讲吗？这个频道来了吗？这个频道来了没有？这个频道还没有来。是我记错了吗？是11点半吗？我们再来看看其他的频道。Yahoo Finance，这个也没有啊。是11点半吗？你们记得吗？是11点半开始吗？我记得是11点啊，宣布。11点半应该是开会啊。我都忘了啊。我们来看一下还有哪个频道。来看看这个，这个可能是上次的，好像是2点30啊，那应该就是11点半。这应该就是这个是上次的那个提问环节啊。今天温哥华雨下的好大，早上送孩子都淋湿了。
From my standpoint, it's not complicated. What everyone on the FOMC wants is a good, solid American economy with strong labor market and price stability.
还有谁来了？大家可以打个招呼吧，让我知道一下谁来了。大家可能都在等11点半啊，我们先预热一下啊，先聊聊天啊。现在发现年纪上去了啊，带孩子真的是挺累的。哎呀，还要做我的视频啊。
I'm not thinking about that. I'm thinking about this.
Thanks, Mr. Chairman. I guess with workplace raids,
这个是上一次的那个，我再看看还有其他的吧。听上次好像没有什么意思啊，我来找找啊。这没有啊，还没有开始啊。大家都在等啊，我看别的直播都在等。这个也是在，这个也是在放之前的。看看 Bloomberg， 我们就看看 Bloomberg 吧，就看看 Bloomberg， 这个算是利率决定前的预测啊，大家都在从市场那个在分析啊，市场的变化在分析。 要到温哥华时间11点半啊，我们先预热一下啊，等到时候会决定的时候啊，应该会有一些人来。还有谁来了？大家可以，我们就听听他们怎么说吧。大家可以打打招呼啊，我也喝喝咖啡啊，吃点零食。阿飞你好，阿飞你好。美国，你好，你好，美国美联储降息啊，到底是降还是不降？是降多少啊？现在目前来看是25个基点啊，还没有宣布啊，一切皆有可能。有猜50个基点的，有猜不降的啊。就像加拿大今天的保持利率不变。前几天在别人的那个直播间啊，也大家也都在争论啊，有些希望还是继续降息啊，但我觉得市场还是这些数据出来，其实应该大家都应该清楚了啊。加拿大的这些数据出来之后，表示的就是这次不会降啊。现在看应该是11点半啊。温哥华时间11点半，多伦多那里，去他们那里是2点半啊，2点30啊。主要是降息之后讲些什么东西啊？大家来了，给姜饼哥点点赞，谢谢大家。把这个位置调整一下，把我的键盘拿过来。桌子有点小啊。这个是 Bloomberg 啊。有2点钟，那是宣布了呀，25个基点股票涨了，11点半可能它是那个 meeting 啊 ，rate cut， 9-3啊 ，vote 是9-3，那他那个为什么不来？我再来看一下啊，他那个怎么都没有放啊。我来找一下啊，是降息已经宣布了啊，我看那个上面已经写了，已经是 rate cut 25个基点了。我们来看这个，我这前面那个。哪个是比较？现在搞不清楚了，找个频道看都。他这会议是11点半开始啊，我们就看这个 Bloomberg 吧 ，Bloomberg 好像。 他这里写着啊 ，Fed say unemployment edge up。9-3啊，降了25个基点啊，降了25个基点。我来找找看看股票是什么情况。股票都转头向上了啊。好像涨幅也不高啊。标普500啊涨了0.09啊，本来是基本不涨啊。道琼斯涨了0.45%啊，这应该是符合预期的吧，所以没有什么大的变化啊。纳斯达克还是下降的啊，没有，虽然是有点翘头了啊，但是还是下降的。2年期的收益率下降了啊，国债收益率下降了。前面我看到一句是keep median 25个 BPS in 2026， 是2026年只降25个基点吧。No rate change.
Mostly as the market expect and nowhere near as bad as the market feared.
So not maybe as hawkish of a cut as people thought it might have been. Joining us now is Jim Bianco of Bianco Research. Jim, what's your first reaction to this decision, which, as Bob was saying, isn't as bad as it could have been? It could have been 4 cents or 5 cents. Only 3 cents. Is this a victory for Jerome Powell?
哎呀，这个直播要找那么多数据，挺难一下子找到的。我来找一下啊。
But he's not going to bully us to cut rates next year just because he's the Fed chairman. They kind of left the door open. I think that the Fed can be bullied by the next Fed chairman.
我来找找有没有点阵图什么的。
Bob, you were saying that you wanted to respond?
Not as good as it could have been with more dissents. I think if you're the administration and you're invested in this market, this is pretty much as good as it could have been, other than no dissents. I'm not sure how additional dissents make this better.
Will McKee dissent at the press conference?
Well, let's find out. Mike, you were parsing through this. You've got something to add. What do you see?
Yeah, well, the point I'd like to make is that the SEP shows that growth
projection material
next year, unemployment is going to go down, and inflation is going to go down significantly next year. So, what was the rush to cut rates today if they think that's the
projection? 哦，我找到了。哎呀，我怎么？我来。
Does this raise the possibility that they could be going the wrong direction with rates? There were some people who made that case before we.
我来找找看，我来从这里上面找一下啊。在哪里？哦，在这里。projection material. OK， 你们来看看这个，这现在我们来一起看看啊，这 projection， 这今天刚刚发布的啊，2点钟发布的啊，就是这个是今天啊，12月10日啊。我们来找找它里面的数字啊，它现在预期啊 ，real GDP 2025年是 September， 这是 September projection， 这个是 December 呀，change， 2025年1.7， 我看明白了。就是说 ，real GDP 啊在9月份的时候是1.6啊，它现在是涨到1.7， 2026年本来是1.8，现在涨到2.3。2027年本来是1.9，现在是2。28年1.8和1.9啊 ，longer run 啊，就长期的是平均1.8。我找到了，我们来看看这个啊，这个好像还有点意思。等会儿一起再来看，等会儿再来看那个。已经降息了啊，查尔斯已经降息了啊，美联储降息25个基点啊，已经降息了啊。现在他现在这个是现在我们来看看他的那个 projection 的他的这个图啊，这个数据图啊。现在道琼斯成交量没有明显放大，反而是缩量，缺乏上涨动力啊。这个要是你是看好要下来了啊。我们再看看这个其他的数字啊。这个 GDP 不看了啊，失业率啊，失业率没有什么大的变化啊，longer run 是4.2%， 9月份的时候预测是4.5%，现在也是4.5%啊，这没有什么大的变化。PC inflation 啊，9月份是预测3.0，现在是2.9啊，这是今年啊，明年是2.6、2.4、2.1、2.1啊，这个是成绩不错，看起来啊。这个是median啊，我们再看看 range 是2.5到3.2之间啊。好像他现在预计是接下来的通胀率会下来。Core PC inflation 啊，下来。OK， 我们看最重要的这个 rate。OK， 先看median 的啊，总体这个就是最准确的这个数字啊，这个是比较准确的数字。9月份的时候预计2025年是3.6啊，3.6就是等于3.7，就现在这个利率嘛。2026年是降到3.4啊，2027年降到3.1，28年也是3.1啊，平均就是3%以上的啊。这个范围是在3.4到3.9之间，2.9到4点，这个就是点阵图嘛，等于是。就有些人投3.9，有些人是之前是还投加息的啊。我们来看看下面的这个数字啊，这个也是 real GDP 啊。25年、26年、27年，就是26年有个增长，27、28会下降啊 GDP。失业率啊，这个是失业率。失业率是25年高一点啊，后来26年、27年都下来一点，也都差不多啊，4点几。这个是图啊，我们再看这个点阵图啊。点阵图2025年所有的人都压住，这个是3.75啊，就所以现在是降到3.75了嘛，对吧？2026年平均的是3.4啊，是这里啊，3.5到3.4。2027年是大多数是在3%，28年也是在3%啊，长期的就是在这个3%左右啊，长期的啊，就未来3年的，这是他现在的 projection 啊，预测接下来的利率变化啊。所以你要想美联储把利率降到3%以下啊，这个好像按照目前的情况是有难度的啊。 所以这是点阵图啊，这个就是点阵图啊。因为现在是12月份嘛，就是最后一个月了，所以现在就是3.75%啊。还有这些人是预测不降息的啊，1、2、3、1、2、3、4、5、6个人预测不降息，1、2、3、4、5、6、7、8、9、10、11、12个人啊，就三分之一预测是不降息，2/3预测降息，一个人是预测降息，他估计股票买了挺多的啊，他要降息50个基点，就有这个人，这个是谁？KZ 来了 ，KZ 你好，你好 KZ。我现在在讲点阵图啊，大家，我现在是把之前直播我都找不到这个东西啊，现在我把这个点阵图找出来了。美联储降息25个基点啊，现在是3.75%。加拿大是没有啊，没有降。你好 KZ 你好。哎呀，你很少有机会来看直播啊，下午的啊，晚上你经常会来，晚上到时候弄点东西吃啊。谢谢你来点赞。谢谢你来点赞啊！我们待会儿11点半啊，还有15分钟，我们来听听那个美联储主席发言啊，看看他发言之后会是什么情况。大家来了就打打招呼啊，看看11点半美联储主席发言之后那个利率走势。好像现在来看的话，2026年还有1次，最多2次降息。现在是3.75啊，到2026年可能保持在，它是写着是3.4啊，3.4就是1次到2次之间。怀念小酒加直播，现在挺难的。一个我喝不了酒啊，在戒酒啊，身体也不好，也不是说身体有什么不好，就是说在减肥啊，所以戒酒啊，一喝酒就是要吃啊，吃的就不健康。你看我现在稍微瘦一点啊，瘦了大概10几斤吧，啊，等过段时间也不能太快啊。有时间我们就聊聊天啊。纳斯达克涨上去一点了，纳斯达克。这个不是的，这个是100啊，这是什么？这个 Russell， 小菜加直播，戒酒就是因为不吃小菜呀。小菜啊，以后吃点什么生鱼片什么，这倒是可以的。就喝个汽水啊！我现在在买的那个，我去买的那个叫什么？苏打水，一罐一罐的苏打水啊！有时候，总想喝点东西啊，晚上喝白开水是没意思，对吧？所以喝点苏打水啊。就其实还是主要，我们这次其实主要还是要看这个点阵图嘛，这个点阵图啊。就降息的幅度啊，你们没有看到什么2%以下啊，没有人预计会降到2%以下啊，这个人肯定是这个人啊，这个点阵图的这个点肯定是这个点啊，他预计明年可以降到2%，这个应该是不可能啊，大家都，你看还有这些人是觉得是不会降太多啊，都在3%，大多数都是在3%以上啊。3点几啊，有一些人说降到2.5%。这个是打了个1吗？打了个1是什么意思？降息25个基点，那加拿大美加之间的利差就减少了，美加之间的利差就减少了。我来找找数据啊。好，加拿大股票涨了， ，S&P 500也涨了，道琼斯也涨了，加元上涨了啊，0.7232了啊，前几天最低的时候，土豆那个时候拼命降息，连着降2个50个基点，去年底的时候只有0.6869啊，现在又涨上去点了。Bitcoin 也上去一点了，黄金更是4242了。这里有买黄金的啊，黄金又回上去了啊。纳斯达克23569啊，不涨不跌。我看看我的股票，我的股票怎么还不涨呢？今天跌了这个。为什么？没问题。好 ，KC 说大家要注意，美联储降息和加拿大央行降息没有直接关系，美联储手里还有 buffer， 可以慢慢降一点啊。加拿大手里可能已经没牌了，2.25%已经是过度刺激的红线了。低于这个利率就别想了。Painkiller 你好，我讲了黄金啊，今天一降息，它这个美元贬值嘛，它对贵金属它就贬值嘛，贵金属就要涨嘛。对啊，加拿大央行现在是手上没有那个，我可以吃零食啊。已经没有牌打了啊。加拿大的neutral rate 啊，就是中性利率啊，是2.5%到2.75%之间。就说你在2.5或者是2.75，这个都算是中性利率啊。这个利率是不会刺激，也不会叫什么？就打压那个经济，也不会刺激经济，也不会打压，一般是在2.5到2.75之间。现在降到2.25的话，他说他现在这个2.25是就他把中性利率往下调了一点嘛，2.25是不刺激也不打压经济啊，所以再往下走的话，这个就是刺激经济了啊，而且现在刺激的不是经济啊，现在我们刺激的通胀。我前几天去家里小熊厕纸用完了，我去看了，准备去买一个，一看没打折，现在30几块了 ，Costco 里面那个小熊厕纸啊，以前10几块、20块，打折的时候我记得16块啊，什么18块，我也觉得已经挺贵了，因为这用的挺快的。后来疫情之后就涨到25、28、29啊。就上一次我买的时候是23块9毛9，它打折的，它本来是28块还是29块，打折打下来24块啊，现在不打折已经33块了啊，我看了这个价格是涨得挺厉害，因为这个你是不可能不用的啊，这个你牛排可以不吃啊，汽油可以不加，这个擦屁股纸你肯定有用的，对吧？所以涨价确实的。可以Pink 的说，刚看了一下金价小涨，可以忽略不计那种。确实它没有大涨，因为25是预期之中了嘛，但已经算涨了4200多了，这个已经涨幅已经算比较可观了。Watt 说，加拿大明年加息。明年应该是，我觉得应该有可能的啊。这个加息，如果通胀控制不住的话啊，可能会加息的啊。这个价格，现在我们现在看到一个，Katie， 你这个你这个那个吃咖喱那个，换个东西，换个词啊，它油管他把它给屏蔽了啊，他这里比较注意那种人啊什么那些啊， 讲人家怎么样。你可以换个词啊，这个咖喱不用啊，咖喱吃了辣的不得了。确实啊，它现在还有一个问题啊，就除了是涨价啊，它还那个量还比较小一点。我上周送我孩子送完了之后，外面下雨啊，那我就在mall里面找了一个地方吃点东西啊。他那里新开的一个什么 butter chicken 啊，印度菜啊，我去尝一下啊，看看那里面好像生意还挺不错的。他说他跟我推荐有一个什么打折的一个就盖浇饭嘛，就是 butter chicken 嘛，招牌菜啊。那我就点了一个，他就说12块9毛9啊，13块9毛9，12块9毛9啊，加税什么13块多，我就点了一个。哈哈，不是让你删除，就是说你换一个词啊，他这个好像评论区他不让你把这个东西，他把你藏起来了。12块9毛9，那菜来了之后味道是不错啊，那我就把那个勺往里面搅了一搅啊，这个鸡我总共数了一下，一块一块鸡，像指甲壳那么大的一块一块鸡啊，可能有6块还是7块，就很少的，当然小的可能还有一些啊，但是这稍微大一点的一块一块，只有6块还是7块，反正就一盒饭，一个 sauce， 一个鸡，连个素菜都没有的，就这个价格啊，12块9毛9，13块9毛9，所以物价上涨其实很大的一部分原因也就是房租啊那些税啊那些太高了再加上物价再上去啊，人工成本再上去啊，他12块9毛9，我也没吃到什么东西，其实他也没有赚到什么东西，我觉得房租那么贵啊。不是，他没有油管没有屏蔽，他不停的给我跳出来，让我问我就这个东西可以，就是说他注意到了这个讲的东西是三哥啊，用个替代词嘛，就省得他因为我要点一下他才会出来啊，我不点他就出不来，有时候没看到他就跳过去了，就你们看不到，就只有我看到。替代词嘛，我们反正现在有些时候其实也不用去讲三哥怎么样啊，三哥其实每个人总都有好坏啊，好人坏人都有啊，他们可能不太注意卫生啊，可能有时候也挺杠精的啊，但是 Will Powell say stagflation 啊，这个评论区老外的评论区说鲍威尔会不会说 stagflation 啊，智障啊？大家觉得美国智障了吗？反正我觉得经济比加拿大要好啊，至少大家还挺有钱的，美国感觉。KZ 说，现在往前面看。KZ 说，现在的通胀已经开始。现在的通胀已经开始疯狂的减量 ，Costco 最近被曝光缺斤少两。Costco 在有些地方不如以前了啊。其实这个短斤缺两的问题，我之前一直是对他们是挺相信的啊，就你去超市买东西啊，或者是那些，我确实一直是挺相信的。但自从有一次我在我家门口那里一个超市里面买东西，就感觉好像差了很多啊，因为我烧出来的量，我平时都知道啊，这点量装这个盒子能装满的。现在烧出来，它可能总重量它不缺啊，就我买的 ground beef 啊，我孩子喜欢吃牛肉碎啊，小孩子炒点东西，我都买一盒回来炒一下之后把它装盒子里面。以前炒完了之后装盒子可以装一盒，现在就是少一点。可能是它往里面加的那个肥肉多了啊，一炒肥肉都变油了，就都走掉了。 我把那个油都撇掉的啊，所以它短期缺粮还有其他的方式啊。我们待会儿看看11:30啊，它应该会有那个，我们来看一下，我来找一下啊，还有哪里开始了吗？11:30，这个还没有开始啊。这个开始了吗？好，我们来转过来啊。搭台已经搭好了啊，待会儿听听他怎么讲啊。我待会把他声音调了大一点啊，我把我的声音调了小一点，大家听他们怎么讲。还有1分钟啊，他就出来了。KG 说，明年注定加息。明年注定加地税是必须的啊，肯定会加的啊。James 6说 ，Costco 东西质量不行。对，现在 Costco 真的是，我不知道美国怎么样啊，加拿大确实是差了很多。
A collective sigh of relief. It could have been a lot worse. That is sort of the message coming from it. The S&P up 0.1%. NASDAQ still suffering a little bit, down 0.2% suffering, I say. Still near all-time highs. And the Russell 2000 seeing that pop up 0.6%. What you are seeing in the bond space, 2s, 10s, and 30s, is this lift to bond price down in yield as people expect to see some sort of bond purchases as well as a rate cut coming in next year. It really seems to me that Jay Powell really has the chance to split the difference.
We'll have to see. I'm going to watch the bond vigilantes. I think they're in the press conference as well. Ed Yardeni's in there somewhere.
Well, let's take a listen to Fed Chair Jerome Powell at his last press conference that of the year and potentially of a rate cut.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although important federal government data for the past couple of months have yet to be released, available public and private sector data suggests that the outlook for employment and inflation has not changed as much since our meeting in October. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals, in light of the balance of risks to employment and inflation, today, the Federal Open Market Committee decided to lower our policy interest rate by a 0.25 percentage point. As a separate matter, we also decided to initiate purchases of shorter-term Treasury securities solely for the purpose of maintaining an ample supply of reserves over time, thus supporting effective control of our policy rate. I will have more to say about monetary policy and its implementation after briefly reviewing economic developments. Although some key government data have yet to be released, available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. In contrast, activity in the housing sector remains weak. The temporary shutdown of the federal government has likely weighed on economic activity in the current quarter, but these effects should be mostly offset by higher growth next quarter, reflecting the reopening. In our summary of economic projections, the median participant projects that real GDP will rise 1.7% this year and 2.3% next year, somewhat stronger than projected in September. In the labor market, although official employment data for October and November are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. The official report on the labor market for September, the most recent release, showed that the unemployment rate continued to edge up, reaching 4.4%, and that job gains had slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. In our SEP, the median projection of the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September, and excluding the volatile food and energy categories, core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have declined from their peaks earlier in the year, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.9% this year and 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.5 to 3.75%. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. A reasonable base case is that the effects of tariffs on inflation will be relatively short-lived, effectively a one-time shift in the price level. Our obligation is to make sure that a one-time increase in the price level does not become an ongoing inflation problem. But with downside risks to employment having risen in recent months, the balance of risks has shifted. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. Accordingly, we judged it appropriate at this meeting to lower our policy rate by a quarter percentage point. With today's decision, we have lowered our policy rate 3/4 of a percentage point over our last 3 meetings. This further normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariffs have passed through. The adjustments to our policy stance since September bring it within a range of plausible estimates of neutral and leave us well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of 2026 and 3.1% at the end of 2027, unchanged from September. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. Let me turn now to issues related to the implementation of monetary policy, with the reminder that these issues are separate from and have no implications for the stance of monetary policy. In light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels. Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the sole purpose of maintaining an ample supply of reserves over time. Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions. In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement, or repo operations, are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning and should be used when economically sensible. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing our inflation sustainably down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Fed, we will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Howard.
Thank you. Howard Schneider with Reuters. Just first turning to the statement, just to be clear, we're on the same page here. The insertion of the phrase, considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of the economy along the baseline outlook?
So, yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
And if I could follow up on the outlook there, it seems like with the additional GDP growth coupled with easing inflation and a fairly steady unemployment rate, this seems like a pretty optimistic outlook for next year. What's given rise to that? Is this an early bet on AI? Is there some sense of improving productivity out there? What's driving that?
So a number of things are driving what's happening in the forecast. And I would say if you look broadly at outside forecasts, you do see a pickup in growth in many of those now too. So it's partly that consumer spending has held up. It's been resilient, and to another degree, it is that AI spending on data centers and related to AI has been holding up business investment. So overall, the baseline expectation for next year is, at least at the Fed, and I think with outside forecasters too, is a pickup in growth from today's relatively low level of 1.7%. I mentioned that the SEP median is 1.7 for this year growth and 2.3 for next year. You actually, some of that is due to the shutdown. So you can take 0.2 out of 2026 and put it in 2025. So it would really be 1.9 and 2.1. But overall, yes, for a few reasons, fiscal policy is going to be supportive. And as I mentioned, AI spending will continue. The consumer continues to spend. So it looks like the baseline would be solid growth next year.
Steve.
Thank you, Mr. Chairman, for taking our questions here. You had previously described rate cuts in terms of a risk management framework, and kind of following up on what Howard was asking, is the risk management phase of rate cuts over here, and have you taken out sufficient insurance, I guess, against potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to get a great deal of data between now and the January meeting, and I'm sure we'll talk more about that. And the data that we get are going to factor into our thinking. But yes, we have, if you go back, we held our policy rate at 5.4% for more than a year because inflation was high, very high, and unemployment and the labor market was really solid at that point. So what happened is over last summer of 24, inflation came down, and the labor market began to show real signs of weakness. And so we decided, as our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. And so we did that. We did some cutting, and then we paused for a while to work our way through what was happening in the middle of the year. And then we resumed cuts in September, and we've cut now 3. We now cut a total of 175 basis points. And as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
If I could just follow up on the SEP, you have a whole lot of a big increase in the growth numbers, but not a big decline in the unemployment numbers. And is that an AI factor in there? What is going on in terms of the dynamic of you get more growth, but you don't get a whole lot of decline in unemployment? Thank you, sir.
So it is, the implication is obviously higher productivity. And some of that may be AI. It just also, I think, productivity has just been almost structurally higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time. So it's basically a good thing. But that's certainly the implication.
Thank you. Colby Smith with the New York Times. Today's decision was clearly very divided. It wasn't just the 2 official dissents against a cut, but there were also soft dissents from 4 others. And I'm just wondering if this reluctance from several people to support recent reductions suggests that there is a much higher bar for cuts in the near term. And what exactly does the committee need to see if things are well positioned right now to support a January reduction?
Sure. So let me just say, as I mentioned, and as I've mentioned here before, the situation is that our 2 goals are a bit in tension, right? So, interestingly, everyone around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks? And what does your forecast look like? And where do you, ultimately, where do you think the bigger risk is? And it's very unusual to have persistent tension between the 2 parts of the mandate. And when you do, this is what you see. And I think it's actually what you would expect to see, and we do see it. Meanwhile, the discussions we have are as good as any we've had in my 14 years at the Fed. They're very thoughtful, respectful, and you just have people who have strong views. And we come together and we reach a place where we can make a decision. We made a decision today. We had 9 out of 12 supported it, so fairly broad support. But it's not like the normal situation where everyone agrees on the direction and what to do. It's more spread out, and I think that's only inherent in the situation. In terms of what it would take, we all have an outlook in terms of what's going to come, but I think ultimately having cut 75 and the effects of the 75 basis points will only begin to be coming in. As I've said before a couple times, we're well positioned to wait to see how the economy evolves. We'll just have to see. And we will get, as you know, quite a bit of data. I should mention on the data, as long as I'm talking about it, that we're going to need to be careful in assessing, particularly the household survey data. There are very technical reasons about the way data are collected in some of these measures, both in inflation and in labor, in the labor market, so that the data may be distorted and not just sort of more volatile, but distorted, and that's really because data was not collected in October and half of November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting. Notwithstanding that, we will have a lot of the December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that what we get for example, CPI or for the household survey, we're gonna look at that really carefully and understand that it may be distorted by very technical factors.
And just one more question on dissents. I mean, you talk about it in a very positive way, just given the complicated nature of the situation we're in economically. But is there any point in which those dissents become counterproductive, either to the Fed's communication and the messaging around the policy path forward?
I don't feel that we're at that point at all. I don't. I would say, again, these are good, thoughtful, respectful discussions, and you hear people say, and you hear many outside analysts say the same thing. I could make a case for either side. I mean, I could make that case. It's a close call. We have to make decisions, and we always hope that the data will give us a clear read. But in this situation, you have competing. If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do two things at once. So at what pace do you move? What size moves do you make, and that kind of thing? And what's the timing of them? It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, there's been some discussion recently of the 1990s. In the 1990s, the committee did two discrete sequences of 3 quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down, or should we think of policy risks as genuinely two-sided from here?
So I don't think that a rate hike is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year. But when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, a data set of 2, now 3. Is not a big data set, but you are right about those 2 3-cut times in the 90s.
If I could follow up, the unemployment rate has been rising very gradually for the better part of 2 years, and indeed the statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors still appear to be feeling restrictive policy from the notwithstanding the 150 basis points in cuts prior to today?
So I think the idea is that with now having cut 75 basis points more now and having policy, I'd call it in a broad range of plausible estimates of neutral, that will be a place which will enable the labor market to stabilize or to only tick up 1 or 2 more tenths, but we won't see, any kind of a sharper downturn, which we haven't seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative, and we feel like we have made progress this year in non-tariff related inflation, and as tariffs come through, as they flow through, that'll show through next year. But as I said, we're well placed to wait and see how that turns out. That is our expectation. But we're going to start to see the data, and it'll tell us whether we were right or not.
Claire.
Claire Jones, Financial Times. A lot of people interpreted your comments at the October meeting that, when there's a foggy situation, we slow down, to mean that, there wouldn't be a cut now, there'd be a cut in January instead. So it'd be good to get a sense of why did the committee decide to move today rather than to move in January instead? Thank you.
Right. So in October, I said that there was no certainty of moving, and that was indeed correct. I said it's possible you could think about it that way, but I was careful to say other people could look at it differently. So why did we move today? I would say point to a couple things. First of all, gradual cooling in the labor market has continued. Unemployment is now up 0.3 from June through September. Payroll jobs averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000, so that would be negative 20,000 per month. And also, just to point out one other thing, surveys of households and businesses both show declining supply and demand for workers. So I think you can say that the labor market has continued to cool gradually, maybe just a touch more gradually than we thought. In terms of inflation, it's come in a touch lower, and I think the evidence is kind of growing that what's happening here is services inflation coming down, and that's offset by increases in goods, and that goods inflation is entirely in sectors where there are tariffs. So that does build on the story, and so far it's only a story, that that the goods inflation, which is really the source of the excess at this point, almost more than half the source of the excess inflation is goods, is tariffs. And you've got to say then, so what do we expect from tariffs? And I would say that is to some extent down to looking for broader economic heat. Do we see a hot economy? Do we see constraints? Do we see what's going on with wages? You saw the ECI report today. It doesn't feel like a hot economy that wants to generate, Phillips curve kind of inflation. So we look at all those things, and we say that this was a decision to make. It obviously wasn't unanimous, but overall that was the judgment that we made, and that's the action we took.
Just on the ample reserves point, how concerned were people around the table about some of the tensions we've seen in money markets? Thank you.
I wouldn't say concerned. So what really happened is this. Balance sheet shrinkage, sometimes called QT, went on. We had a framework in place for monitoring it, and nothing happened. The overnight reverse repo facility went down pretty much close to zero. And then beginning in September, the federal funds rate started to tick up within the range, right? And it ticked up almost all the way to interest-on reserve balances. There's nothing wrong with that. What that's telling you is that we're actually in an ample reserves regime. So, we knew this was going to come. When it finally did come, it came a little quicker than expected, but we were absolutely there to take the actions that we said we would take. So, and those actions are today. So, we announced that we're resuming reserve management purchases. That is completely separate from monetary policy. It's just we need to keep an ample supply of reserves out there. Why so big? The answer to that is, if you look ahead, you'll see that April 15th is coming up, and our framework is such that we want to have ample reserves even at times when reserves are at a low level temporarily. So that's what happens on tax day. People pay a lot of money to the government, reserves drop sharply and temporarily. So this seasonal buildup that we'll see in the next few months was going to happen anyway. It was going to happen because April 15th is April 15th. There's also a secular ongoing growth of the balance sheet. We have to keep reserves, call it constant, as it relates to the banking system or to the whole economy. And that alone calls for us to increase about $20–25 billion per month. So that's a small part. That's going on. It's also happening in the context of a temporary few-month front loading to get reserves high enough to get through the tax period in mid-April. So that's what's happening there.
Thanks, Mr. Chairman. This is the last post-FOMC press conference before an important Supreme Court hearing next month. Can you talk about how you're hoping the Supreme Court will rule? And I'm just curious why the Fed's been so reticent on such a pivotal matter.
It's not something I want to address here, Andrew. We're not legal commentators. It's before the courts, and we think we don't think that we help matters by trying to engage as a public discussant of that. I'll give you a mulligan, though.
No, thanks. I don't know if that means I get 3 questions, but
no, just one more.
I guess I wanted to come back to the 1990s question, and like, do you see that as a useful model for thinking about what is happening in the economy right now?
I don't think it rises to that level. So I did think that in 2019, where we cut 3 times, but this is such a unique situation. It's not the 1970s, let's put it that way, but we do have tension between our 2 goals. And so that's just unique in my time at the Fed, and I think going back a long ways, we haven't had that. In our framework, as you know, says that when that's the case, that we try to take a balanced approach to the 2 things, and we look at how far they are and how long it would take to get them back to each of them back to the goal. And that's a very subjective analysis, really, but it just tells you you've got to. And I think ultimately what it says is when they're broadly equally threatened or equally at risk, you should be kind of neutral, because if you're either accommodative or tight, you're favoring one or the other goal. And so we've been sort of moving in the direction of neutral. Now we're in the range of neutral. We're in the high end of the range of neutral, I would say, and that's what we're doing now. It so happened that we've cut 3 times. That we haven't made any decision about January, but as I've said, we think we're well positioned to wait and see how the economy performs.
Edward.
Thanks, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, the inflation expectations has come down in your SEP report. Do you see the tariff price increases as passing through in the next 3 months? Is it a 6-month process that we're looking for that to end? And then because of that, is jobs the threat to the economy?
So with tariff inflation, there's the announcement of a tariff, and then there's, they start to take effect, and then it takes some months. Goods may have to be shipped from other parts of the, it may take, quite a while for an individual tariff to take its full effect. But once it's had that effect, then the question is, isn't that just a one-time price increase? So we actually look at it, all of the announcements and what you get from all that. You see sort of for each one of them, there's a time period, and then it's fully in. So if there are no new tariff announcements, and we don't know that, but let's assume there are no major new tariff announcements, inflation from goods should peak in the first quarter or so, right, or roughly. We haven't been able to predict this with any precision. No one is. But call it the first quarter or so of next year should be the peak. And from here, it shouldn't be big. It should be a couple tenths or even less than that. We don't really have precision on this. And after that, again, if there are no new tariffs that are being announced that will take 9 months to get fully in, and 9 months is also an estimate, then you should start to see that coming down in the back half of next year.
And I want to see if I could address sort of the elephant in the room. The president's been talking openly about a new Fed chairman. Does that hinder your current job right now or change your thinking at all?
No.
No mulligans for it. Michael McKee from Bloomberg Radio and Television. 10-year rates are 50 basis points higher than when you started cutting back in September of 2024, and the yield curve basically has been steepening. Why do you think that continuing to cut now, especially in the absence of data, is going to bring down the yield on the thing that will move the economy the most?
So we're looking at the real economy and focusing on that. And you've got it when the long bonds move around, you've got to look at why they're moving around. If you look at inflation compensation, it's very that's one part of it is inflation compensation break-evens, and they're at very comfortable levels. They're at levels consistent once you get out past the very short term now. break-evens are at at quite levels that are quite consistent with 2% inflation over time. So there's nothing happening with rates going up out there that suggests concern about inflation in the long term or anything like that. I mean, I look at these things pretty regularly. Same thing with surveys. Surveys are all saying that the public understands our commitment to 2% and expects us to get back there. So why are rates going up? It has to be something else. It must be, an expectation of higher growth or something like that. And that's a lot of what's been going on. I mean, you saw a big move, toward the end of last year, which was not to do with us. It was to do with other developments.
Well, you just mentioned that the public is expecting you to get back to 2%, and Americans overwhelmingly are citing high prices, inflation, as their number one concern. Can you explain to them why you're prioritizing the labor market, which seems relatively stable to most people, instead of their number one concern, inflation?
So we, as you know, we have a network of contacts in the U.S. economy, which is really unmatched if you go through the 12 reserve banks. So we hear loud and clear how people are experiencing really costs. It's really high costs. And a lot of that is not the current rate of inflation. A lot of that is just embedded higher cost due to higher inflation in 2022 and 23. So that's what's going on. And so the best thing we can do is restore inflation to its 2% goal, and our policy is intended to do that, but also have a strong economy where real wages are going up, where people are getting jobs and earning money, and we're going to need to have some years where real compensation is higher. It's positive, significantly positive. So nominal wages are higher than inflation, for people to start feeling good about the affordability issue. And so we're working hard on that. We're trying to keep inflation under control, but also support the labor market and strong wages, so that people are earning enough money and feeling economically healthy again.
Victoria.
Hi, Victoria Guida with Politico. Just to follow up on that, I mean, this is now the third time that you've cut this year, and inflation is around 3%. So is the message that you're sort of trying to send with that you're okay with where inflation is for now, as long as people understand that at some point you still want to get back to 2%, because inflation is relatively stable where it is?
Everyone should understand, and the surveys show that they do, that we're committed to 2% inflation, and we will deliver 2% inflation. But it's a complicated, unusual, difficult situation where the labor market is also under pressure, where job creation may actually be negative. Now, supply of workers has also gone way down, so the unemployment rate hasn't moved that much. But it's a labor market that seems to have significant downside risks. People care a lot about that. That's their jobs. That's their ability, if they get laid off or if they're entering the labor force, to find work. So that's really important to people. The story with inflation, and we're well aware that this is a story at this point, is that if you get away from tariffs, inflation is in the low 2s, right? So it's really tariffs that's caused most of the inflation overshoot. And we do think of those as likely to, in the current situation, as likely to be a one-time price increase. Our job is to make sure that it is, and we will do that job. But right now, you've got this difficult balance, and there are risks to both sides. There's no risk-free path. If it was just inflation and the labor market was just really strong, and then rates would be higher, as they were for more than a year. We didn't have to worry about inflation. Sorry, about the labor market, because the labor market unemployment was very low. If you remember, when inflation was very high, there was a labor shortage, so we could focus entirely on inflation. Now it's different. We actually have risks to both, and I think we're doing the best we can for people. They also care about their jobs. They do care about affordability, and the best thing we can do there is both to support economic activity, but also, make sure that when tariff inflation goes down and disappears, inflation lands around 2%.
Elizabeth.
Thanks so much, Elizabeth Schulze with ABC News. Just to follow up, you keep talking about job growth being negative. Why do you think job growth is so much worse than some of the official data? Why do you think job growth is, to follow up on your comments about job growth, why is it so much worse than the official data is suggesting?
Oh, well, we know, I think I don't think this is particularly controversial. It's very difficult to estimate job growth in real time. They don't count everybody, they have a survey. And there's been something of a systematic overcount. And so we expected, and they correct it twice a year. So the last time they corrected it, we thought the correction would be 800,000 or 900,000. I won't get the numbers exactly right. And that was exactly what happened. So we think that has persisted. And so there's an overcount in the payroll job numbers, we think, continuing, and it will be corrected. I don't have the exact month in my head right now, and that's just, I think forecasters generally understand that. So, and we think it's about 60,000 a month, so 40,000 jobs could be negative 20, and that could be wrong by 10 or 20 in either direction. But in any case, but the thing is, that's job creation in a way. That's demand. Labor supply has also come down quite sharply. So, if you had a world where there's just no growth in workers and you really don't need a lot of jobs to have full employment, some people argue that's what we're looking at. But I think a world where job creation is negative, I just think we need to watch that situation very carefully and be in a position where we're not, pushing down on job creation with our policy.
When we're talking about supply, we have seen major American employers like Amazon cite AI in job cuts. How much right now are you factoring in AI into the current weakness in the job market?
So it's probably part of the story. It's not a big part of the story yet. We don't know whether it will be. But, for example, if you look at, you can't miss the big announcements of layoffs and also companies saying that they're not going to hire anybody for a long time, and they cite AI. That's all clearly happening. At the same time, people are not filing for unemployment insurance, and since job creation, job finding rates are extremely low, if there were big numbers of layoffs, you'd expect the continuing claims to go up, and you expect new claims to go up. It really haven't much. So it's a little bit curious. But longer term, though, the question is, what are we going to see here? And we don't know, but it's it may be that in past technology, really significant technology innovation eras, you have seen some jobs destroyed and other jobs made. Ultimately, what's happened for a couple hundred years is, when you get through all that, you have higher productivity and you have new jobs, and there are enough jobs for people. This may be different. It's every time we have a wave of technology, we think, oh, this could put a lot of people out of work. What are they going to do? In the past, there's always been more work and higher productivity, and incomes have risen. What will happen here, we're going to have to see. But right now is such early days. We don't think we see much. It's certainly not showing up in layoffs yet.
Thank you, Chair. Enda Curran, Bloomberg News. Given the breadth of views on the policy committee, why is there such a division of views between
the policy what? On
the committee.
Thank you.
Why is there such a division of views between the presidents and the board members?
It's not so stark as that. The views are more varied in each group as well. There's some of that, but I would say they're also governors and they're people on both sides in both groups. I wouldn't put too much in that.
Okay, and just to follow up, please, given your growth upgrade, how would you factor in, or what would be the economic impact if the Supreme Court is to strike down the tariffs that they're currently hearing, please, in terms of growth and inflation? Thank you.
I really don't know. It would depend. It would depend on a whole bunch of things we don't know. So I can't really help you there.
Christine.
Thank you, Chair Powell. Christine Romans, NBC News. I wanted to ask you about how the higher income households are really driving spending right now. They're backed by home equity and stock market wealth, but lower income consumers are really struggling with the accumulation of 5 years now of rising prices. It's price levels, not really the inflation rate, holding some of these families back. How sustainable is this so-called K-shaped economy, and what are the Fed's thoughts on whether that's a risk going forward?
So we do, through our vast network of contacts and just through our observation of what's going on in the economy, we hear about this a lot. If you listen to the earnings reports for consumer-facing companies that tend to deal with low and moderate income people, they'll all say that we're seeing people, tightening their belts, changing products that they buy, buying less, and that sort of thing. And so it's clearly a thing. It's also clearly a thing that, asset values, housing values, and securities values are high, and they tend to be owned by people more at the higher end of the income and wealth. So as how sustainable it is, I don't know. Most of the consumption does happen by people who have more means. I think the top third accounts for way more than a third of the consumption, for example. So it's a good question how sustainable that is. The best we can do is to have a price stability and a strong labor market. What we saw, for example, what we saw at the end of the very, very long expansion that ended with the outbreak of the pandemic, we saw that it was 10 years and 8 months or something like that, the longest one in recorded history. In the last 2 years, most of the largest part of the wage gains were going to people in the bottom quartile, the bottom part of the low and moderate income. So, having a strong labor market for a long period of time is really, really good from a social standpoint. It's helping people at the lower income levels, and that's what we all want to get back to. But we got to have price stability, and we got to have full employment, maximum employment.
And just quickly, you mentioned the housing market remains kind of weak. With these rate cuts that we've seen, is there a chance we're going to see more affordability in the housing market so more people can maybe enjoy that part of wealth creation? I mean, the average age or median age of a first-time home buyer is now 40 years old. That's the highest on record.
Yeah, so the housing market faces some really significant challenges. And I don't know that, a 25 basis point decline in the federal funds rate is going to make much of a difference for people. Housing supply is low. Many people have very, very low rate mortgages from the pandemic period, and they kept refinancing and caught the really low. So it's made expensive for them to move. And we're a ways away from that changing. Also, we haven't built enough housing in the country for a long time, and so a lot of estimates suggest that we just need more housing of different kinds. So housing is going to be a problem, and really the tools to address it are we can raise and lower interest rates, but we don't really have the tools to address a secular housing shortage, a structural housing shortage.
Thanks. Chris Rugaber, Associated Press. You mentioned on inflation, services inflation being low, goods inflation looking like maybe it'll peak. We had the wages report you mentioned today showing moderating wage growth. Where are the inflation risks? It looks like inflation is cooling, in your view. At the same time, you have potentially negative hiring. Why not? Why aren't we hearing more about maybe more cuts in this environment?
Well, I think the risk in inflation is pretty clear to see, and that is, we see higher inflation. As I mentioned, most of the inflation over target is from goods, and we expect, most of us, that inflation will be a one-time price increase and then come down. We just came off an experience where inflation turned out to be much more persistent than anyone had expected. Is that going to happen now? That's the risk. The risk is either that tariff inflation just turns out to be more and more persistent, maybe because companies who are now holding back from passing through the tariffs will just keep doing that. So you see that. I think the other possibility is less likely, and that is just that the labor market gets tight or the economy gets tight, and you see just traditional inflation. I don't see that as particularly likely. But so I think again all across the committee, people see the picture pretty similarly, but see the risks quite differently. And some people do see the inflation risk, and I wouldn't dismiss that case. I don't dismiss that case, but you've got to make an assessment, and this is the assessment we made.
Hi, Chair Powell. Neil Irwin with Axios. So this has come up a couple of times today, but to be clear, do you believe that we're experiencing a positive productivity shock, whether from AI or policy factors or whatever? And how much is that driving the higher GDP projection in the SEP?
So yeah, I mean, I never thought I would see a time when we had 5-6 years of 2% productivity growth. This is higher. This is definitely higher, and it was before it could be attributed to AI. I also think if you look at what AI can do, and if you use it in your personal life, as I imagine many of us have, you can see the prospects for productivity. I think it makes people who use it more productive. It may make other people have to find other jobs, though. So it could have productivity implications while also having social and labor market implications that we don't have the tools to deal with. But yes, I think we're definitely seeing higher productivity. I think it's a little quick to be saying it's generative AI, but I don't know. The pandemic may have induced people to do more automation and do more things with computers to replace people, and that raises productivity, output per hour.
Does that imply a higher neutral rate, and therefore the policy might be a little easier than it seems?
All things equal, yes, but all things aren't equal. There are many things pushing in different directions on where the neutral rate would be. But yes, that argument does come up.
Matt Egan.
Thanks, Chair Powell. Matt Egan with CNN. After today, you only have 3 more meetings at the helm of the Fed. Since becoming Fed chair, you've seen multiple trade wars, the pandemic, COVID reopening, period of high inflation. I know your term's not up as chair until May, but I'm wondering if you've given any thought to what you want your legacy to be.
My legacy. My thought is that I really want to turn this job over to whoever replaces me with the economy in really good shape. That's what I want to do. I want inflation to be under control, coming back down to 2%, and I want the labor market to be strong. That's what I want. And all of my efforts are to get to that place. They have been all along, but ultimately, that's what I'm. And it's I don't have time to think about bigger things. I hope many years ahead to worry about that, but there's enough to do.
Relatedly, have you given any more thought, and can you tell us any more about your plans on whether or not you plan to stay on the Fed Board of Governors even after your term as chair expires?
Again, I'm focused on my remaining time as chair. I haven't got anything new on that to tell you.
Go to Mark for the last question.
Chairman Mark Hamrick with Bankrate. Even while many price levels remain elevated, the reductions in the federal funds rate means that savings rates, or yields to be more precise, have peaked, while key borrowing rates remain elevated. And that's, as we've discussed here, as many Americans struggle with liquidity or emergency savings challenges. Is that just collateral damage or an unintended consequence because your tools are limited in addressing individual or household liquidity constraints, insufficient money in the bank?
I don't know. I wouldn't agree that that's collateral damage of our. I mean, over time, we do what we do in order to create price stability and maximum employment, and those things are hugely valuable to all the people we serve. When we raise rates to bring inflation down, that does work by slowing the economy, but we've moved back our policy back down to where it's not. It's certainly not strongly restrictive at this point. I think it's sort of in the range of neutral. So that's what we're trying to do, and I would want people to understand that. I think what people are feeling is the effect of higher prices. There was a global wave. Sort of every large economy in the world, sort of every large open economy, market-based economy in the world had a wave of inflation that looked an awful lot like ours. We actually came through better than any other country, substantially better. We had higher growth, we had better labor market, and this is really due to the American economy. We have an extraordinary economy, and people are innovative, they work hard, and so all of us who work in economics jobs are really fortunate to have the U.S. economy. So, thank you very much.
This is the Fed Decides on Bloomberg Television and Radio. Fed Chair Jay Powell wrapping up his news conference, the last news conference of 2025. A Fed that's divided, but not as divided.
"好了，还有谁在？大家听他讲完了啊。我们，我们再直播一会儿啊。我们来讲讲今天讲了点什么啊。今天是降了25个基点啊，25个基点。现在是3.75%啊，本来是4%，3.75%。明年的 projection 啊，我们来看一下 projection 啊，还有谁在啊？有谁在评论区打个招呼啊？我来看一下还有谁在啊？我们待会儿大概再讲一下啊，可能有些人没看到啊 projection。明年，哎呀，我把这个得看 projection 应该是这样。明年GDP 增长啊，这个是9月份的，这个是有些人之前可能看过，我讲过了啊，这个是2025年的12月10日啊，他今天刚出的那个 projection 啊，预测啊 GDP 增长比之前要好一点啊，就业数据差不多啊，只有一点点的变化。Inflation 啊，这个是变化挺大的啊，特别是明年啊，它本来是2.6，现在是2.4。好，我们再看这个利率啊，利率的变化跟之前的 projection 没什么大的区别啊。明年是今年是3.6啊，就这个是 median 啊，就中位数3.6。明年是3.4啊，一次降息，可能还有一次降息，或者是最多2次啊，最多2次。到2027年是3.1啊，可能3.1的话就基本上是3.3到3.25，可能是2次降息。2028年也是，所以就是目前来看的话，未来2年啊，美国的利率还有2次啊，最多3次降息啊，2次到3次的降息。好，我们再来看一下它这个点阵图，是错过了吧？啊，这个点阵图啊，这个点阵图啊，这个今年的，现在基本上都是3.75啊，3.5到3.75啊，这个是明年的，明年的就稍微再下来一点啊，所以这个就等于说是差不多了，就差不多是这点。好，我们再来回到这里。好，不用去看那么多数据了，我们就讲讲我们现在看到的情况啊。他在后面的讲话里面基本上就是反复就在讲通胀的压力，通胀是因为关税啊造成的，就是商品的价格上升，和什么这种服务这些的啊，都还是可以控制的啊，所以他在说，反复的在强调通胀压力减小了啊，他们现在主要是看那个就业的机会啊，就业的工作岗位的变化，而且最近因为是美联储之前那个美国联邦政府关门了啊，所以现在数据很多都没有出来啊，他可能在接下来一段时间，可能数据出来之后会继续啊，就他目前看到的情况啊，目前能看到的情况，现在是就业压力比较大一点啊。这个他之前说了，那个就是那个 payroll 啊，就像我们加拿大一样啊，这个 payroll 的数据不好啊 ，payroll 的数据不好，所以他觉得那个就业数据也是应该是不好啊，所以他今天整个讲话基本上就是在放歌啊，所以在他讲话之后，我们看到来看一下。我们看到这个股票都往上在涨了啊，加拿大股票涨了0.79%， 还有半个小时收盘啊0.8%，标普500也涨了0.8%，道琼斯涨了1.23%，加元不是说加元升值了，就是美元贬值了，现在是0.725啊，0.725啊，美元贬值了，油价也出现上涨了58.93%，比特币也涨了0.47%。黄金更是4266了啊！黄金我们看看和之前的高点比，高点是4390啊，现在是4266。10年期国债收益率啊，这个变化其实不是太大啊，但是其实也是从之前的低点啊3.9啊4%以下，现在已经又涨回到了4.16%啊。这个国债收益率其实10年期的又回到了之前啊。纳斯达克现在是涨了0.49啊，在他讲话之后，这个恐慌指数啊大幅度下降啊，下降8%啊，7.91，现在是15.59啊，这个是恐慌指数。我估计他这个讲话之后，接下来就是美元贬值，那些其他的货币或者是加密或者是黄金升值。你们在评论区说说还有谁在啊？大家打声招呼吧。人多的话，很多的话，有谁在？我们到时候再继续讲一会儿啊。今天看到的你还在吗 ？KZ 还在吗？之前留言的那些观众还有谁在啊？好，我们再来讲一下。现在看还有11位观众在观看啊，我们继续讲一下。我来把东西找出来啊。所以加拿大今天是选择是保持利率不变啊，美国是降息25个基点啊，说明加拿大的利率基本上已经到底了美国还有降息的空间啊，加拿大是已经没有降息的空间了，所以在这次通胀率和那个 GDP 的数据啊，都不是通胀率，就是那个就业数据和 GDP 的数据啊，都给出了一个很好的答案之后啊，他就选择保持利率不变。但是保持利率不变的话，其实还有一个问题，就是我们现在5年期的加拿大国债收益率涨得挺厉害的啊，现在已经涨到了今年年初1月份的时候啊3.06%啊，我来看看现在是多少，今天早上看是3.06%，现在可能又继续上了，因为它没有降息嘛。我来看一下啊。Bond yield curve， 好，我们来看一下数据啊。我们来看一下数据。点了什么东西了？怎么跳不出来？打错了。重来。啊，我们来了啊！我们来看一下啊。现在10年期的是3.434啊。比之前最高昨天最高的时候4.45几啊，稍微下降了一点点啊。5年期的啊，我们来看一下5年期的，5年期的现在是3.04啊，也稍微下来一点点啊，前面看是3.0，今天早上看是3.06但是5年期的这个国债收益率已经比一年前呢。来看一下这个 curve， 已经涨到了之前就是2025年1月份 就2025年1月20号的那个价格啊，2025年1月20号的时候是3.01，就等于说它接下来在加拿大是连着降了2次，再加上1月份、2月份啊，一共降了3次，75个基点啊。这个5年期的国债收益率是没有下降啊，所以国债收益率不下降的话，结果就是我们看到那个贷款利率也就下不来啊。现在我看好像之前最低的时候，最低的5年期锁定贷款利率和3年期啊，都基本上是在最低的啊是3.69啊。5大银行 post 给出来的最低利率是4%左右啊，4以上。你可能谈得好一点的话，可以拿到更低的啊，但是基本上都是他在那个网站上 post 出来都是4%左右。所以我们现在能够看到的最低的利率啊，最低的利率啊，现在是我来再看一下啊 ，Ron Buller 现在给出的最低利率是3.84啊，3.5年期的锁定利率是3.84。今天基本上就是这点东西啦。美国降0.25啊，加拿大没降啊。我们接下来再看看会有什么变化。好了，今天我去弄点吃的啊，到现在午饭都没吃啊。现在今天就到这里吧，好吗？拜拜。哎，怎么关不掉了？我来把它关掉。怎么死机了？